back to Wealth Dynasty. Thanks for joining us again today. Today we have a really awesome episode. We're going to be talking about LIRPs, L-I-R-P. And Tucker, what is a LIRP?
A LIRP stands for Life Insurance Retirement Plan.
Life Insurance Retirement Plans. Very, very interesting episode. So here we go.
Well, Mark, what questions do you have for me today?
First off, what is a LIRP?
So Life Insurance Retirement Plan. It's using the tax benefits of life insurance and the internal buildup of cash value to create distributions in retirement or prior to retirement on a tax-free basis.
Okay, so this is like a life insurance product plus a retirement fund or a pension or something like that? Or how would you, if we were just to break this down to like the most simplest terms, is that something similar to like that?
Yeah, so inside of any permanent life insurance policy, for the most part, whether it's whole life, universal life, indexed universal life or IUL, or variable universal life, all those have some cash value building up inside the policy, which can be used for distributions on a tax-free basis.
Awesome. So this is insurance play, and it's also a tax play.
Correct. And it's an accumulation play.
Okay.
And to the whole basis of it, the value is, of course, there's life insurance, which means that if somebody dies early, the beneficiary is going to get far more than what was put into the policy.
Okay.
On a tax-free basis.
Yeah.
Assume it's owned properly. Okay. And the concept behind it is that if you are in a high earner and a high tax bracket, and you're an investor as well, and you have accounts outside of your qualified money accounts, such as your 401k, your pension plan, or your SEP, or whatever it might be, you have money that you need to invest outside of that, then any kind of investment you make in a brokerage account of any sort, there's going to be a taxation, whether it be capital gains, ordinary income against interest income, dividends, whatever it might be, is going to create tax, which is a big drag on the ultimate return or the money you get to spend down the road.
I think that's just something that a lot of people don't think of is, they only see like, oh, I'm going to make 12% on this. But when you factor in the fees and the taxes and all, anything else that goes into these, I mean, maybe, 8, 7, 9%, who knows where that really the actual number, the net number comes out to be.
Right. And the higher the tax bracket, of course, the bigger impact it has on your accounts.
Correct. Yeah. Okay. That makes sense.
And so the benefit of the life insurance is that you can have growth type of accounts inside the life insurance without paying tax currently on the growth, and that ultimately you can access that money through withdrawals and loans without paying a tax on it.
That's amazing. Yeah.
And so the tax is more expensive than the internal cost of the life insurance. And that's the leverage.
Okay, so the tax in a brokerage account that's just a regular brokerage account, non-qualified, is going to be higher than all the internal costs for a LIRP.
Correct.
That's amazing.
Yeah. And actually, if you consider that compared to tax-deductible accounts, when you take money out of those, ultimately, that's taxed at ordinary income.
Correct.
And one thing that people don't realize is that because of tax bracket creep, or the fact that they've got a lot of money saved in these qualified plans, their tax bracket in retirement may be pretty high.
Yeah.
Okay, higher than they think it's going to be. And nobody knows that because that's a future situation, and nobody knows that. But the truth is that the federal government has an interest in all your retirement accounts.
Correct. A financial interest.
They have a financial
interest.
Very
deep financial interest.
Okay, because at some point they're going to tax that.
Correct. Yeah.
Okay, except for Roth accounts, of course.
Roth, yeah, because all the growth is all
right.
tax-free.
So,
but you get taxed on the front end, so
yeah,
they're getting some,
which is like life insurance. You get taxed on the front end.
Okay.
It grows tax deferred, so it's mostly like the Roth account.
So this is like the LIRP is like a Roth with life insurance,
right?
Something like that.
And the life insurance works, especially for folks that are making too much money to really participate in a Roth account.
Yeah.
Okay. Now there are Roth 401ks now that people can participate in. That's great. Okay. But it's not a tax deduction.
Yeah.
Okay. And for people in high incomes that are already maximizing their qualified account opportunities, this is a great way to have money set aside for yourself on a tax favored basis.
I mean, this is really killing two birds with one stone. If you think about it, you have your insurance, which you need to have, and it's permanent coverage. So you're going to have this until the day that you die, whether that's tomorrow or 120 years from now. And you also have a big old stack of money that's growing that you could literally take loans from for free. It's like you're your own bank, essentially. Take a loan. If you want to pay it back, you can. If not, that just comes out of the death benefit. Is that correct?
Correct.
Okay.
So I won't say the loans are free
Mhm.
because usually the insurance companies charge some sort of interest on those. And that varies based on the product and the company.
How much would that? I mean, is it like right now interest rates are like 6%, 5, 6%?
Yeah. So, well,
I mean, that's with the Fed or whatever, you
yeah,
know.
so there's different products, right? The universal life, index universal life, and variable universal life, typically after about 10 years, their loans are contractually about either 0 or 1%, something like that. They're quite low.
Yeah, that's crazy
Okay.
though. Yeah.
Whole life is different. They're going to have a contractual interest rate, 5 to 8%, something like that.
Yeah.
Now, so there's, a higher interest rate typically applies to the whole life.
Okay.
But let's kind of break down the various products that are available. Okay,
Yeah.
let's kind of break that down. So whole life would be on a scale of 1 to 10, safety wise, it's a 1. Or a 10 safety wise. Okay.
Oh, 10 is
10 super
safest
safety.
to safe.
Okay.
Yeah, yeah.
Or risk wise, it's a 1. There's no
Yeah,
risk.
one, no risk, almost at all. Yeah, yeah.
Okay. And then, because you have you got guaranteed premium, guaranteed cash value, guaranteed death benefit.
Yeah.
Okay. Pays dividends on top of that.
Okay.
So that's where it's the dividends that make the difference in the whole life. Without the dividends, the whole life wouldn't work very well.
Yeah.
But the dividends are pretty steady and have a great history. Then you go to universal life, which is an a fixed interest rate based product. And that's, of course, recently, the last few years, the universal life hasn't been that big, not that popular because interest rates have been so low.
Yeah.
And it's not really.
And those interest rates depend on what the Fed's got set currently, or what are those?
Well, they're fixed interest rates, so they're typically going to run close to a treasury.
Okay.
Something like that.
Yeah.
Okay. But that's, it's very safe, but it's not enough growth in those typically to get too excited about.
Yeah. And then on a scale of like 1 to 10, as 1 being completely safe and secure, and 10 being completely
maybe like
risky.
a 2 or 3, maybe something like that.
So still super, super.
But the concept works. Okay. And in higher interest rates environments, they're very good. Okay. But that doesn't look like that's going to happen anytime soon.
Yeah, we got to stimulate the economy.
Yeah. Back in the 80s, those looked really good.
Yeah.
But the next step up is the index universal life, which on a scale of 1 to 10, risk-wise, is probably a 5, something like that. Maybe a 5 or a 5.5, something like that. And there, the product is more interesting because the cash value accounts are typically tied to it's indexed, right? Index universal life. So it's tied to an index, most typically the S&P 500. But there are other indexes available depending upon the company, the product. Some are quite creative. The basic idea behind that is you've got a floor and a cap, meaning that they tie it to the growth of the S&P 500. They don't actually invest in the S&P 500. They invest in bonds and options on the S&P 500, okay, which allows them to mitigate the risk.
Yeah, that's
all right. And so what happens is that they guarantee that there's a floor to it. The worst that can happen is typically a 0 return.
So the S&P does -20.
You get 0.
You get 0. So you're not losing anything. You're just essentially, didn't make anything either.
Right. So that's a big benefit over a typical brokerage account, right? Because if the S&P 500 loses 20,
ooh, man,
you're losing 20.
That hurts. Yeah. That hurts.
And you know, back in 2008,
7, 8,
9,
9.
7,
Those,
8, 9,
yeah.
those were scary years, tough years. 2009 in particular, where there was huge losses, 40% losses, and people were very worried. Okay, and it creates a lot of anxiety. So the great news in a situation like that, you got a zero and you're starting off low. Okay, so the next year, hopefully you actually make some money. Okay, you step up.
Yeah.
Okay, you don't go backwards. But it has a cap. So the cap means that you can only earn so much on it.
And is the cap a certain percentage, or is it like, let's say the S&P 500 does, 20%, I can only max out at 70% of what they do, or what does those caps look like?
So on the most basic level, the cap might be 9%. Okay, so if the S&P 500 does 20, you get 9.
Ooh.
Okay. If the S&P 500, if the cap's 9, if the S&P 500 does 7, you get 7. All right. If the S&P 500 does negative 20, you get 0.
That's nice.
Okay. So that's kind of how that works. Now, there's all sorts of variations to that type of index where they will actually help you can earn quite a bit more than that. Okay. However, I've also heard, just people talking to me about people have, offered them index universal life for their grandkids, for example, and touting returns of 40% or something like that. That's unrealistic.
That's insane. Yeah.
That's overselling that by far.
Correct.
And, typical normal return is going to be on average probably 6 to 8%, something like that.
Okay.
Okay, that
That's
would be
averaged
a normal
over 40 years.
Yeah, over a period
30,
of time.
20,
I mean, some of
some
the accounts have averaged 8 or 9, and they may average that in the future, but typically it's 6 to 8 is going to be your range. Okay, that's a realistic range, and actually it's a range that works.
Yeah.
Okay, so if you can get 6 to 8% without the downside, not bad.
Not bad at all.
Okay.
Yeah.
And also, as I mentioned before, the real benefit here is that you could do a similar type of investment in your brokerage account to some degree. I mean, you can, put in bonds, you put in treasuries and then stocks and so forth and have a mixed account, but you have to pay tax on that.
Yeah.
So the life insurance, you're not paying the tax, which is, even though there are costs to the insurance, there are administrative costs in the policy, it's less than the tax.
Tax on a regular brokerage account.
Yeah, that's the benefit.
Okay.
Okay.
And then the payout, obviously life insurance is 100% tax-free, and any cash value you have stored up, if that goes to your beneficiary, that's 100% tax-free.
Correct.
Also.
Right. Well, so the life insurance policy pays out a death benefit, right? They have different death benefit options on life insurance. So talking about universal life, well, you've got option 1 or option 2 or a couple other options. Option 1 means you got a level death benefit. The cash value grows, but the death benefit does not increase with the cash value. Option 2, as the cash value increases, the death benefit increases. With whole life, you've got a guaranteed amount, but with dividends, the death benefit and the cash value increase. Okay. With variable life, same thing, option 1, option 2, but there, of course, you're actually invested in the market with sub-accounts, which are equivalent to managed mutual funds. You can typically, most companies have a index fund, a S&P 500 index type account in there, which is low cost, but you can, manage those, and you can have some in bonds, some in stocks, but they're all sub-accounts. They're all like mutual funds.
Yeah.
Okay. That's also a possibility.
Perfect.
But there, of course, in a variable life, you don't have a floor.
Yeah.
Okay. So if you're invested in the S&P 500 index fund inside the variable life, it makes 20%, you get 20%. If it loses 20%, you lose 20%.
So obviously on a scale of 1 to 10, that's going to be like
10, well, compared to a regular
whole life
investment account.
Okay. Yeah. It'd be the same as an investment account, except you also have the insurance with it. So you're never ever going to lose it all.
Well,
you
could if the cash value went to 0, you could lose it all.
You'd lose the cash value, but you still have the death benefit.
No, not necessarily.
Okay.
Not
you could
necessarily.
especially. Okay.
So let's talk about some of the dangers.
Yeah.
Or some of the negatives. So there are internal costs, and that's probably why people don't They don't know what those internal costs are. They can't picture that. It's not as transparent as they're used to. Whole life is not transparent at all. Index universal life is transparent, as well as variable life, very transparent.
Very transparent,
You can know what all the fees are and everything. But there's, the thought of insurance. Maybe they don't want insurance, or they think I don't need insurance because there is a cost to that. And you have to qualify for it too.
Correct. Yeah,
So
if
you
you're
have to be healthy enough.
uninsurable. Yeah.
You have to be healthy enough to get it.
Mm-hmm.
So the dangers are if you take out a policy and you have lots of cash value in it, and the idea behind a LIRP also is that you're minimizing the death benefit, maximizing the cash value.
Okay.
Opposite of term, right? Term, you're minimizing the premium, maximizing the death benefit, but you're minimizing the death benefit so to keep the costs low. And so then, so the danger is that if down the road you take out too much money, take out all the money, you got a big loan on it, and you're 90 years old and you take out too much money, and the policy lapses, it could create a taxable event. Okay, which would be very negative.
Yeah.
Okay, it could be a big taxable event,
Taxes and all
a
that.
big surprise. So it has to be managed. It has to be, you have to go into it knowing what you're doing, recognizing that it has to be managed, meaning you have to keep track of how much cash value is in there relative to the death benefit, and make sure that policy stays in force.
Perfect.
So some policies, variable universal life in particular, have locks in place so that after a certain point of time, you can lock in the death benefit, never have to worry about it lapsing. Okay. And so it'll never lapse.
Yeah.
So that's an important feature.
They have those on all different types, like whole life, IULs.
Whole life is
VULs.
kind of already guaranteed.
The IULs and the VULs have the lock.
They don't necessarily have the lock. Okay. They don't need it as much. The variable life, you really need it because if there's a big drop in the market,
Yeah, you could lease.
you could get hurt badly quickly. Okay. And not have any control over it.
Yeah,
And so those are all, with the others, you can manage them and typically not have to worry too much.
that's good.
But you just have to make, so that's another negative in a way, that you can't get all the money out of the policy, okay, without creating a problem.
Yeah,
But here, you got to remember you're doing that. There's this twofold thing. You got life insurance. There has to be a need for life insurance too, or a desire for life insurance. And so people might say, oh, I don't need any life insurance, so why would I do this? I know people, single people, that want the benefits of it, but the beneficiary might be a niece or a nephew, could be a charitable organization, could be parent.
could be somebody taking care of my cats when I die.
Yeah,
you know.
it could be anything like that.
Yeah.
Okay. And knowing that the death benefit is not going to be that big because we're building it up and then taking it down.
Yeah.
Okay. So the death benefit is not that huge, typically relative to the total
Totally.
package. Okay.
Because essentially this is a retirement plan.
Right.
So you're trying to hit retirement and use the money, and then have a little bit left essentially for burying yourself, or maybe more than that to give a little bit to your kids or beneficiaries.
Yeah. So it's a very useful tool. It's a responsible tool. It's something that is highly beneficial to the insured if they use it properly. It's also another way to save money, create a different bucket of money for yourself. Diversify. I mean, personally, I've always been a little tense about qualified money because I've learned over the years that the federal government does have an interest in that money. And, with qualified money, if you need money early on in your life, before age 59 and a half, you're going to have a 10% tax penalty. With life insurance, that doesn't exist.
Take out a loan. Yeah, I want to buy, you buy a house or a second property or whatever. I need the down payment. I could just take that as a loan.
Correct.
And then pay it back if I want to. And
Pay it back. Depends how you want to do it. Okay. With qualified money, you got to pay tax on that and a penalty. And that becomes and especially when usually you need it the most when the market's down.
Yeah. Everybody just lost their job.
Right. I need money.
I need my money.
But there's a 10% tax penalty.
Yeah,
you get it
so
out.
Get worse. You hit even worse with
you
it.
Get a hit on the value, 30% hit on the value. Then you got to pay 10% tax to get it out. Plus the tax.
Yeah.
It's not fun.
Banged up.
You're just like, what am I doing this for? And, or I've seen people who stacked away money all these years and then they retire. They're actually in a higher tax bracket in their retirement than they were during their working years.
Hey, that's tough.
And so it gives a lie to the whole concept of, put money in when you're a high tax bracket and get it out when you're low. It doesn't always work that way.
Yeah.
You know, life insurance gets rid of all that nonsense.
Yeah. So,
and also you can put as much as you want. So with a Roth IRA, which is great, you can only put in so much money. It's limited.
caps. Yeah.